Hello, everyone. Thank you so much for joining today's IMM seminar. So today we're very happy to invite Dr. Fulin Li, Assistant Professor of Finance at Texas A&M University, to present her paper for us. And also, we are very happy to invite Dr. Toomas Laarits from NYU Stern to serve as today's discussant. So for all of our audience, if you have questions, feel free to unmute yourself during the talk, and Fulin will be very happy to answer your questions. So, all right, then we can get started. So, Fulin, the floor is yours.
Thanks, everyone, for being here, and thanks for putting the paper in the seminar series. This is joint work with Inxi Xie at Indiana University. Since the beginning of 2025, we all know that the U.S. has initiated a rapid and widespread series of trade wars against the rest of the world. We have seen rapid sequences of tariff hikes, pauses, and reversals, and often announced through President Trump's social media account. And the market repeatedly revised their expectations about future U.S. economic policy in response. And this has triggered a recent debate about the resilience of the U.S. safe asset system. And in particular, people question whether the U.S. will still remain the world's safe haven with escalated geopolitical tensions. In this paper, we're going to focus on a specific aspect of the U.S. safe haven status, which is the safety or liquidity in the U.S. treasuries measured by the convenience yield. So the U.S. treasuries can offer a lower yield relative to other assets with similar cash flows because investors value its liquidity and safety benefits. And this spread is known as the convenience yield. So in this paper, we're going to answer 3 questions about the U.S. convenience yields and the trade policy tensions. And first, qualitatively, do trade policy surprises increase or decrease convenience yields? And second, quantitatively, how large the effects are. And finally, we're going to look into the specific channels. And in particular, we're going to highlight a specific uncertainty channel, which is the trade policy induced uncertainty. So before we take a quick look at the data at the convenience yield movement, I want to first pause here and just try to think at a high level how the trade policy tensions could affect the convenience yield. I think the conventional wisdom is that trade policy tensions would increase the U.S. convenience yield for at least 2 reasons. The first is that the U.S. could raise more revenues from higher tariffs, and this would improve the U.S. fiscal stance, and this would increase the convenience yield. And also there is this flight to safety argument saying that global risk shocks would drive investors outside risky assets and into safer U.S. treasuries. And this would also cause the convenience yield to increase in response to trade policy tensions. However, I think in light of the recent trade tensions in 2025, there is also a third popular narrative saying that the trade wars may also undermine the confidence in U.S. assets for the following reason. So basically, investors want to insulate themselves from the fiscal or political shocks originated from the U.S. policy itself. So it's a story about the U.S. policy generates economic uncertainty, and it also causes, for example, fears of U.S. recession. These kind of economic uncertainty lead investors to insulate themselves from the U.S. shocks. I think there's a question in the audience, right?
Well, can I ask just, it seems to me there's an even more direct channel, just that in the pre-tariff war era, U.S. ran trade deficits with many counterparties. Most of those trade deficits then ended up in purchase of treasuries. I mean, it could be other asset or could work other way, but the way it worked historically is just there's lots of trade deficits and those go into purchase of treasuries. So now if the large tariffs reduce the deficits, then just there's going to be fewer flows into treasuries going forward. You see, so it seems to me that's a more direct channel. It doesn't go against anything you have on the slide, but do you see that as part of those or a separate one?
Yeah, and this would imply a decrease, like if
In
you're
the convenience, yeah.
in the convenience yield.
Yeah.
I do think that this could be included as like a fourth channel, and that would work in the same direction as this like uncertainty channel we highlighted in the paper. I think as we get to like the specific empirical exercise we did with the uncertainty channel, we can discuss how we can, for example, if we want to tease out the contribution of these different channels, whether there is some exercises we could do. All right. If there's no other questions, I'll move on. Okay, so let's first take a quick look at the data and get a sense of whether the U.S. trade policy announcements indeed is associated with lower U.S. convenience yield. So here I'm plotting a measure of the U.S. convenience yield, which is a swap spread. It is the maturity matched swap rate minus the treasury yield. And this swap rate is from a SOFR-based interest rate swap. So it's essentially the fixed rate you receive, you receive in exchange for the floating of SOFR interest rate. Basically, if investors think there is safety or liquidity benefit in the U.S. treasuries, they would demand a lower yield on the U.S. treasury, and that would imply that this U.S. convenience yield measure would be higher. So the higher this measure, the more the safe haven status of the U.S. treasuries. The solid black line in this figure is at the 1-year maturity, and the dotted blue line is the 10-year maturity. We see that around the Liberation Day tariffs, for both maturities, the convenience yield measures drop sharply. And we see that for the longer maturities, it already started to recover in early September, while for the shorter maturities, the recovery is much later. So at least from these like daily movements in the U.S. convenience yield, we see that perhaps the tariff announcements is indeed associated with a lower convenience yield. But of course, the challenges are the measurement and the second, the identification. So the conventional approach in terms of measuring U.S. trade policy surprises or tensions is either coming from text-based measures or from certain lower frequency tariff indicators. And these measures cannot distinguish, for example, expected versus unexpected tariff changes, and is of course at lower frequency. So the main contribution in our paper is this measurement first. We use transaction level data from tariff-related prediction markets. So this gives us a measure of real-time forward-looking tariff expectations. And I'll explain in the next few slides how this measure is constructed in greater detail. With this real-time measure, we could identify the causal effect of trade policy surprise on convenience yield. And we're going to use a high frequency identification approach that is standard in the monetary policy shock literature. So it's essentially a Nakamura-Stanson exercise. And this allows us to first directly measure trade policy surprise, and second, to quantify their dynamic impact on U.S. convenience yields. I'll give you a brief overview of the results. So first is the measurement, is the trade policy surprise coming from a particular prediction market called poly market. And at a high level, this trade policy surprise is essentially the market price changes from the poly market tariff-related markets. The higher this trade policy surprise measure means a higher probability of the U.S. increasing tariff on the rest of the world. And we have 3 sets of main results from this high-frequency event study approach. So basically, we have a list of U.S. tariff announcements, and we look at the trade policy surprise measure within a 30-minute window around these tariff announcements. The first set of results is in terms of the direct effect of trade policy surprise on U.S. convenience yields. We see that one standard deviation in our trade policy surprise measure leads to a 0.2 to 0.5 basis points decrease in the U.S. convenience yields, depending on the maturity. And this would translate into a 0.5 to 1.2 basis points decrease in convenience yields around the Liberation Day tariffs in early April 2025. And the effect is persistent for up to 30 days. The second set of results is in terms of this uncertainty channel I explained in a previous slide. So it's basically the story is that trade policy surprise would lead to increased U.S. economic uncertainty and perceived higher risk of U.S. recession. And this TPS-induced uncertainty, we show that it quantitatively explains a large fraction of the variation in convenience yield. So we think quantitatively the TPS-induced uncertainty is an important channel. And finally, we also look across maturities and examine whether it's the safety or liquidity component that contributes to the erosion of a convenience yield. And we find that for the shorter maturity, it's the erosion in the safety benefit of the U.S. Treasury, while for the longer maturity, it's mostly the erosion of the liquidity benefit. So that's the overview of the results. And in the interest of time, I'll just skip the literature section and directly talk about the data. I think one of the major contributions of this paper is the high frequency measure of the trade policy surprise. So I'm going to go into the details of this. The data is from one of the largest prediction markets, which is Polymarket. The other large market is Kalshi, which primarily serves U.S. investors. Polymarket has a monthly trading volume of $6 billion as of the end of December 2025. And on this platform, investors essentially bet on whether a real-world event will occur or not. I'm going to show you 3 examples of these tariff-related markets on Polymarket. So each line in this figure corresponds to a tariff-related market. For example, the solid blue line says that will Trump impose large tariffs in his first 6 months? So it's essentially a binary option, which has a payoff of $1 if that outcome is realized, and the payoff is 0 otherwise. So for this particular event, it means that the contract will pay $1 if Trump imposes large tariff in his first 6 months and $0 otherwise. The price of this contract is interpreted as the risk-neutral probability of this event occurs. So it's essentially the risk-neutral probability of President Trump imposing large tariffs in his first 6 months. And you might wonder what we mean by large tariffs. And there is actually a list of rules that specifies what is large. For example, for this particular market, it will resolve to yes if the U.S. weighted average tariff reaches 5% or greater for the first 2 quarters of 2025. So there's essentially no ambiguity in terms of the resolution of these contracts. Okay, so now we understand that the prices are essentially the risk-neutral probability of future tariffs. Then we can look at these 3 specific contracts and have a quick look at the daily prices in this figure and see whether these prices make sense. The first event, this first shaded area I highlighted, is a series of tariff announcements in early February. So essentially on January the 31st, President Trump first announced that he's going to increase tariff on China, Mexico, and Canada. And we see that the Trump tariff in first 6 months, that contract prices immediately jumps up. And also in the blue line, we have a contract that bets on 25% of tariff on Mexico and Canada. And we see that the contract price also jumps up on January the 31st. However, after 3 days, President Trump reversed this decision on Mexico and Canada and says that we're going to pause the tariff hike on Mexico and Canada. And we see that the prices of these 2 contracts immediately jumps down. And in fact, this second contract with 25% of tariff on Mexico or Canada resolves after that announcement. So at least after eyeballing these 3 contracts prices movements, we see that the contract prices can capture the probability of tariff increase or decrease. And more importantly, this can reflect the market's expectation about future tariff increase or decrease. Now I'm going to get into the details of the trade policy surprise shock construction. We focus on 2 types of trade policy related contracts. The first one is just betting on a binary outcome. Will Trump impose large tariffs in his first 6 months or not? So it's essentially there are only 2 outcomes. The second type of contracts has different outcomes. For example, which countries will the U.S. agree to trade deals with before July? So basically, each contract specifies a target country. For example, the target country could be China, and this means that the contract essentially bets on whether the U.S. will agree to trade deals with China. And the second one is EU, and the contract would be, will the U.S. agree to trade deals with EU? For each of these contracts, we still have these binary yes or no outcomes, and the payoff would depend on whether this event is realized or not. This first type of contract allows us to use its price changes to measure the revisions in investor expectations about future tariff policies. And this gives us the primary trade policies of price measure. The second type of contracts allow us to examine the cross-section of countries because each contract bet on the tariff increase against a certain country. And later on, we'll show that this gives us a cross-section identification strategy. Now I'm going to get into the details of the trade policy surprise construction. First, in terms of the sample period, it starts from November the 18th, 2024, because the first tariff-related contracts on poly market started to trade on November the 18th. And we have 63 distinct contracts being selected from the following procedure. It's essentially we retrieve contracts with certain trade-related keywords and then drop markets with lower trading volume. And then we keep the type 1 contracts I just explained, and also the type 2 contracts associated with the G10 currencies. So in terms of the trading volume in these selected contracts, we see that the trading volume peaked in April of 2025. This is the month where the Liberation Day tariff and also the 90-day tariff pause was announced. The total trading volume of these 63 markets is around $15 million in April 2025. And we see, of course, after the July 2025, the trading volume and the dollar trading volume actually dropped significantly until the end of the year. So now I'm going to explain in detail how we construct the trade policy surprise measure around President Trump's trade announcements, and also explain this event study approach. We have several types of events, and most notably, we have President Trump's Truth Social post. We observed that more than 1/3 of these trade policy announcements were actually made through President Trump's Truth Social post. And some other announcement revenues include the White House briefings and releases on its websites, and also announcements from the Executive Office of the President. So we have 96 tariff-related announcements in total, and announced on 76 event days. For each of these event days, we observe all transactions in all the selected markets. For each transaction in the selected market, we can adjust its price by the market outcome. So we have this adjusted market price that can be interpreted as the probability of tariff increase. So for example, if the yes outcome corresponds to tariff increase, then we can directly take the market price. If the yes outcome corresponds to tariff decrease, then we are going to take 1 minus the price, and this would give us the interpretation of still the interpretation of a probability of tariff increase. So the higher this adjusted price, the higher the probability of a tariff increase. With this adjusted price in hand, we can do the Nakamura-Stevenson exercise. For each tariff policy announcement at timestamp T, we first focus on the 30-minute window around that tariff announcement. We compute the price change. It's the price change in that adjusted price within this 30-minute window. And this is our market level trade policy surprise. And then we aggregate this market level trade policy surprise to a trade policy surprise for this specific tariff announcement using the principal component analysis approach. And our trade policy surprise measure is essentially the first principal component extracted from this cross-section of poly markets. And just to re-emphasize the interpretation of this trade policy surprise measure, the higher this measure, the higher the probability of a future tariff increase of the U.S. on foreign countries. Now let's take a look at this trade policy surprise measure on the tariff announcement days and see whether the magnitude or the direction of this measure makes sense. Each bar represents the trade policy surprise on a given tariff announcement date. We see that the largest positive values occur in early April, which are the days essentially where the Liberation Day tariffs are announced. The largest negative value occurs on April the 9th. This is the date on which President Trump announced a 90-day tariff pause on the rest of the world, except China. So in terms of the magnitude or the direction, the trade policy surprise measure makes a lot of sense. And we also take a look at the trade level prices and examine whether there are any pre-drift or post-event moves around specific tariff announcements. The left panel shows the prices, the trade level prices within a 30-minute window around a specific tariff event, which is this April the 9th 90-day tariff pause event. It was announced at 1 p.m. Eastern Time on April the 9th. If we look at the 30 minutes before this announcement, we see that there is no pre-drift in terms of the prices. And in terms of the post-announcement moves, we see that the price started to decrease. And recall that this price is the probability of a tariff increase. And the lower this price, it means the lower the probability of a tariff increase. And this actually conforms with the direction of this particular announcement, which is a 90-day tariff pause.
Well, I was just going to observe in the previous graph you had, there's a number of days, April 8th, April 9th, April 10th, for instance, or May 28th to May 29th, that day to day see a big swing, a big negative autocorrelation, it seems, right? Like market on April 9 is a big negative news. On April 10, some of it is given back. And I think part of it reflects for sure the reality on the ground, that there are lots of news in opposite directions, but it potentially, maybe there's a test you could do. There's some kind of staleness in the prices or the overreaction in a way
I see.
Arising from just illiquidity. So it would be perhaps useful to say something on that. I don't think it will matter too much, but to the extent you say that the new data is valuable and hopefully other people can use it, it would be nice to say something on the liquidity of these markets.
Yes, I think that's a nice observation, and it matters for our interpretation of this trade policy surprise measure. Like, we essentially want to interpret this measure as like what the unexpected tariff increase. But if some of these are like initial overreaction, then later on certain corrections in that, then perhaps we need to think more carefully about that interpretation. And we can talk more about that after we show the event study results. And there we can also have some discussions about the interpretation of those results. Okay, so we basically see that there is no pre-drift and there's a strong post-announcement movement in the trade prices. And this gives us more confidence in this measurement. Now we can do the event study around President Trump's tariff announcements. Basically, we do the following local projection. The left-hand side is the cumulative change in convenience yield from the market close right before the announcement to several days after the announcement. And the right-hand side is our trade policy surprise measure. Remember, this is a high-frequency measure around a 30-minute window around that tariff announcement. This coefficient beta is the coefficient of interest. It tells us the impulse response of convenience yield to trade policy surprise. This is a figure that shows our main results, which is the direct effect of trade policy surprise on U.S. convenience yield across different maturities. We see that for maturities from 1 to 30 years, a 1 standard deviation increase in trade policy surprise leads to a 50 basis points. It leads to a 0.5 basis points decrease in the convenience yields across all of these maturities. During the Liberation Day tariff events, which is the announcements from April the 1st to April the 5th, there is a 2 standard deviations increase in our trade policy surprise measure. So this would translate into a 1 basis point decrease in convenience yield just within 5 days. We also do a robustness test by using a different measure of the U.S. Treasury's safe haven status, which is the Treasury basis. This is essentially the 3-month CIP deviation. It's the foreign government bond yield minus the U.S. Treasury yield and adjusting for exchange rate risk. If investors value the safety and liquidity benefit of U.S. government, they would demand lower yield from U.S. government, and this measure would go up. So essentially, the higher this CIP deviation measure, the higher the perceived safe haven status of the U.S. relative to a foreign country. And remember that we have these type 2 markets, which bets on specific tariff increase on specific countries. And so we can have a cross section of countries and run a panel regression where each observation is a market, and the market is associated with a specific country. And each observation is a market trade announcement level observation. This panel regression also gives us a similar picture. It shows that when there is a trade policy, the trade policy surprise increases, this CIP deviation measure decreases, which means the U.S. safe haven status is eroded. So taken together, both the U.S. convenience swap yield measure and the CIP deviation measure tells us that trade policy surprise decreases the U.S. convenience yield, and this is a causal story. For the remaining of the talk, I'll spend some time discussing this uncertainty channel I highlighted at the beginning of this presentation. So it's essentially, we conjectured that the U.S. trade policy induces economic uncertainty, and investors would want to insulate themselves from these political or fiscal shocks initiated from the U.S. policy itself.
Before we get into that, I was curious about the term structure aspect. Could you say a bit more on the one before? So there is a gap that in the terms structure. Right, so all the maturities see a drop in convenience yields, but it seems the 30-year for sure is the strongest, and the 3-month the weakest. So I was wondering, perhaps with respect to the channels you outlined originally, do you have any idea? Do you have any thoughts on what that represents, the term structure difference?
So first, I think you're talking about the magnitude, like a 0.2.
Yes. I don't know if these are comparable directly. I forget how you normalize things, but yeah.
I think these are directly comparable.
Yeah.
These are swaps to read at different maturities and annualized. So first, that safety versus liquidity decomposition across maturities, that one is more about a qualitative argument.
Okay.
In terms of this, in terms of just the quantitative difference, like 0.2 basis point versus 0.5 basis point, we could actually translate those estimates from the liquidity and safety decomposition into, for example, the 0.2 basis point. We could say that X% of that is coming from the safety erosion in these short-term treasuries. And then because 3-month and 1 month are both short term, we could do a decomposition and see whether the contribution of the safety part has any difference in these two different maturities. We haven't done that exercise yet, but I think that's important.
Mm-hmm. I have a question about something related to this. So at the beginning, you showed us the graph that includes the convenience yield of the 1-year treasuries and 10-year treasuries, right? And 10-year treasuries convenience yield started increasing, right?
Exactly.
So how can you reconcile your finding with this empirical empirical fact? So
yeah, that is a very nice observation. So first, in the latter half of 2025, we do see certain events, tariff announcements, that actually implies a decrease in tariff. I have a list of these tariff announcements. We can talk about that if we have time. And second is I'll have some exercise in that, uncertainty in that tariff-induced uncertainty section. And actually, we see that during the latter half of 2025, there's lower tariff-induced uncertainty, and that would lead to this reversal of the longer-term U.S. communist yield. So maybe we can defer this discussion as to that section of this uncertainty, trade policy induced uncertainty section, and then we can discuss it further.
Okay, thank you.
Okay, so let me actually go back to the beginning of this uncertainty channel discussion. So first, we first want to take a quick look at several uncertainty measures. The first one is obviously the VIX. This is the impulse response of VIX. The middle panel is the impulse response of VIX to our trade policy surprise measure. We see that on impact, there is a 3.6% increase in VIX in response to the trade policy surprise measure, and the effect is also persistent. And in the literature, there's also a second uncertainty measure, which is a trade policy specific uncertainty measure that's coming from the newspaper text. It's essentially counting the newspaper articles mention trade policy uncertainty as a fraction of the total number of news articles. We see that text-based trade policy uncertainty also increases in response to trade policy surprise. So we say from these two figures, we can conclude that trade policy surprise indeed induce increased economic uncertainty in the U.S. So our conjecture channel is this TPS-induced uncertainty lowers the convenience yield. And to examine whether this is quantitatively important for convenience yield, and also going back to the previous question, whether this can explain the recovery of long-term convenience yield starting September 2025, we're going to do this two-stage regression. The first stage is essentially the effect of trade policy surprise on an uncertainty measure, and we're going to use VIX throughout this paper. The second stage is using the fitted value of the VIX. So is the fitted value coming from the trade policy surprise, the high frequency trade policy surprise, using this to explain the changes in convenience yield. So if you take these two stages together, it's essentially using trade policy surprise as an instrument for changes in VIX. So this exercise gives us this beta coefficient from the second stage, and this beta coefficient tells us the causal effect of trade policy induced uncertainty on convenience yield. And later on, we are going to use this beta VIX estimate to see whether this is quantitatively important for the convenience yield dynamics throughout 2025. So in terms of the beta coefficient, we see that the coefficient is significant across all maturities. And just to translate these numbers and see whether this is consistent with our baseline effect of trade policy on convenience yield. So this from the previous figure, we see that a 1 standard deviation increase in trade policy surprise leads to a 3.6% increase in VIX on impact. And for example, for the 10-year maturity, a 1 standard deviation, the increase in the VIX leads to a 0.13 basis point decrease in the 10-year convenience yield. So if we multiply these two numbers together, this is precisely the 0.5 basis point decrease in convenience yield we show in the first impulse response picture for the 10-year maturity. So this is the interpretation of these coefficients. And then before we use these coefficients to quantitatively explain the convenience yield movement, I want to show a second piece of evidence that highlights that this uncertainty channel might have a bite. So essentially, there is another polymarket contract which bets on the US recession in 2025. We use the prices from this market to measure the perceived probability of a US recession. And we are going to examine the effect of trade policy surprise on the perceived recession probability. And we indeed see that trade policy surprise leads to a 1% increase in perceived US recession probability. And we think this is one of the sources for why investors want to insulate themselves from US Treasuries. Okay. Now, finally, in this trade policy induced uncertainty section, we are going to do a quantitative exercise. We want to see how much of the 2025 decline or recovery in coming years yields can be attributed to trade policy surprise induced uncertainty. So the exercise is using this beta VIX coefficient from our two-stage least square regression. And remember, this coefficient is the causal effect of trade policy induced uncertainty on US coming years yield. We multiply the cumulative change in VIX by this beta coefficient, and this gives us a fitted change in US coming years yield. And it is a cumulative change in coming years yield relative to a starting date. We set the starting date to be President Trump's inauguration date in January 2025. In each of these panels, we plot two lines. The solid black line is the actual cumulative change in US coming years yield for a given maturity. The dotted blue line is our fitted change coming from this previous slide. We see that for all across the maturity structure, the correlation, we have a very high correlation ranging from 0.2 to 0.5. And in terms of the explained variation of the fitted series relative to the actual series, the explained variation is between 3% to 23%, and it has large variation across maturities. And going back to the previous question about the recovery of long-term US coming years yield, we see that for the 10-year maturity, this trade policy induced uncertainty can partially account for this recovery of the long-term coming years yield. Although I don't have a good a quantitative estimate of for example, how large that fraction is. Perhaps we could do some further exercise, for example, partition this full sample period into the pre-September versus post-September period and see whether the correlation is still high or whether the explained variation is still high. And also going back to the previous question about what explains the difference in the maturity structure, I think we do see some difference in terms of the fitting, especially after September 2025 across different maturities. And I think we need to take a closer look at this as well. Okay, for the rest of the talk, I think I have about 12 minutes, right? I'm going to talk about the last section, the last set of findings in this paper, which is the safety versus liquidity component decomposition. We decompose the coming years yields into a safety premium and a liquidity premium using the Ref Corp bonds. So Ref Corp bonds are bonds issued by the Resolution Fund Incorporation. These are bonds fully backed by the U.S. Treasury, and they are subject to the same taxation as the U.S. Treasuries. So we interpret these bonds as being as safe as the U.S. Treasuries. So the spread between these bonds yields and the U.S. Treasury yield would be capturing the liquidity benefit of U.S. government bonds, of the U.S. Treasury. So this is the liquidity premium I'm referring to. And the rest of the coming years yield, we're going to interpret it as the safety premium of U.S. Treasuries. So basically, we can also plot the impulse response of these two different components in response to the trade policy surprises. First, in terms of that liquidity premium, which is measured as the Ref Corp yield minus the U.S. Treasury yield, we see that it shows up on the longer maturities. So for both the 5-year and 10-year maturity, the liquidity benefit of U.S. Treasuries actually decreases. And this primarily contributes to the decrease in coming years yields for these longer maturities. while for the shorter maturities, we do see an increase in this liquidity benefit on impact, although the effect is neither significant nor persistent. And in terms of the remaining component, which is the safety benefit, we see that the safety premium of shorter term U.S. Treasuries decreases in response to the trade policy surprise. A 1 standard deviation increase in the trade policy surprise would lead to a 1 basis point decrease in this safety component. While for the longer maturities, we do not see a very significant effect. And taken together, we see that for longer maturities, the trade policy surprise primarily erode its liquidity premium. And for shorter treasuries, the communist yield decline is mostly coming from the safety erosion.
But that's Fulin. Wouldn't you expect the CDS rates to reflect safety erosion if it's there?
Yeah, exactly. If you think that part of the safety is coming from the U.S. default risk, then the U.S. CDS premium would capture that. We actually have an exercise in the appendix that shows that the default risk actually increases in response to the trade policy surprise across maturities. But the problem is the confidence interval is too wide. That's the only reason why we didn't include it in the main text. So it's a little bit hard to tease out this default risk argument, perhaps because of the illiquidity of the CDS market. So I don't know whether there is a cleaner exercise that can kind of isolate that illiquidity part of the CDS premium. But if you have any suggestions, that would help a lot.
So is safety captured by the price volatility of the treasuries?
I said again, you mean the safety?
So how do you capture the safety of treasuries then?
Yeah, I think this is a little bit muddied in the sense that we interpret whatever is left. We first measure liquidity using this ref corp versus treasury spread, and we interpret whatever is left as the safety premium. So we acknowledge that this may not be the safety could mean a lot of things, and as Tom pointed out, it could mean the default risk of the U.S. government. But the safety premium we have here could also reflect, for example, the regulatory advantage of the U.S. and several other things. So I think the safety measure we have here would not be a very clean measure of the safety, and it also depends on what specific safety we have in mind.
To me, liquidity is how easily you can liquidate it, right? So how easily sell it when you have a treasury bond, and safety is related to risk of default or the change in the price. So if you sell it, you might have to sell it at a lower price than before, right? So I'm not sure if this measure captures liquidity versus safety. Yeah, but that's just my comment. Yeah.
Yeah. I kind of get your point about this, the changes in price could also, I think the changes in price is kind of need to be a little bit careful about the interpretation. For example, if you think the market is very illiquid, then the changes in price would also incorporate that illiquidity as well.
I don't have a great suggestion, but I just wanted to point out what I think about the liquidity versus safety. So
yeah, I'm totally on board with you.
Thanks.
I think I'm just on time. Okay, let me conclude here. So we make two major contributions in this paper. The first is that when we propose a new trade policy surprise measure that's coming from high frequency price changes around the tariff announcement. And second, using this high frequency trade policy surprise measure, we provide causal evidence on trade policy surprise on U.S. convenience yield. We show that the trade policy induced uncertainty is an important channel for the erosion of U.S. convenience yield. And it also challenges the traditional flight to safety story. for at least for this specific 2025 trade tension episode. That's it. Thank you.
Thank you so much, Fulin. A great talk. So we can now switch to Toomas to give your talk a discussion. And also after Toomas' talk, Fulin, feel free to respond to his comments.
All right, thank you very much. I'll do a brief discussion. Thanks a lot for having me and for the opportunity to engage with the paper carefully. So, what determines treasury yields? That's the big question, and a topical one, and one on top of many investors' minds for the past couple of years. And one driver of convenience yields that recent literature has emphasized is this idea of convenience. Convenience yield dynamics can present a separate dimension of yield movements from some of the, perhaps, from the other macroeconomic factors that have been studied. And so what did authors do in this paper? Well, they bring to the table new data from prediction markets that allows us to measure with high frequency the level of expected tariffs. And so in these very volatile times when there were news daily, intraday even, on the trade stance of the United States, I think this data is incredibly valuable. And the authors pitched their analysis mainly in the force of two competing, as a trade-off between two competing forces. One, just any sort of uncertainty market-wide can affect convenience yields. And separately, to the extent tariffs raise more revenue, they can shore up the finances, the fiscal picture of the US, and potentially be beneficial to convenience yields. So I wanted to contextualize some of the data Fulin showed by providing complementary evidence from some of my own work. So let me just show you one picture here. I'm showing here daily data from April 24 to 26 of the TIPS Treasury proxy for the convenience yield. So Fulin focused on a swap spread. So here is a slightly different one. It's a very related measure that basically compares synthetic nominal treasuries constructed out of TIPS and inflation swaps with actual traded nominal treasuries. And in historic data, the synthetic treasuries that are less convenient than the actual traded treasuries carry a yield premium of about 25 basis points. Okay, so here in April 24, you see the solid blue line, the 10-year TIPS yield was maybe 25 basis points lower than the synthetic kind of frictionless benchmark. Okay, and so what do we see on Liberation Day in early April 25? Well, we see that the 10-year convenience yield proxy here, it dipped, and it actually dipped to a negative value, basically the first time in this whole sample. And then, by the way, again, recently at the onset of the Iran conflict, this 10-year convenience yield again dipped below zero. But one thing that's quite interesting that is distinct from the swap measure-based convenience yield that Fulin and the co-author used is that in this TIPS Treasury convenience yield measure, the short-term convenience yields in fact went up. So there was a rotation, we call it. So you see in the dashed light blue line, short-term, the 2-year convenience yield rallied by close to 15 basis points when the long-term convenience yield dipped. So there was a change where the convenience yield is earned, more so in the short term, consistent with this view that high volatility times see flight to quality, whereas in the long term it dips. Okay, let me skip this one. And so what we do in a paper with Veera Licharya, or maybe even two papers that Fulin generously cites, is we look at this we look at the treasury yields, and we look to decompose them into three components. We decompose treasury yields into a risk-free rate, CDS, default rate, and a convenience yield premium. And then what we do is with those three components of treasury yields, we look at the stock bond covariance as it arises from innovations to each of those three components. Okay? And so what we find historically is convenience yield innovations themselves are part of the hedge that treasuries provide. In other words, in volatile times, typically, in the past 20 years for sure, it's been the case that convenience yields increase, and convenience yields increase in a way that has a negative covariance with aggregate equity market movements. Okay? So convenience yields themselves provide a hedge. Kind of in bad macroeconomic realizations, in bad stock market realizations, convenience yields go up. So that raises by just a negative beta, by a hedge phenomenon, it raises the present value of the convenience flows that a treasury affords. And what we find is that this aspect of long-term treasuries quite dramatically switched in the tariff war era. So in the solid blue line here, I'm showing the covariance between aggregate equity market returns and the convenience yield innovations for 10, 5, and 2-year treasuries. And what we find is that the 10-year treasury convenience yield actually was a risky flow, right? So very much consistent with what Fulin is showing, but kind of a different way of measuring it. So in in days when stock market plummeted, the convenience yield on 10-year went down too, whereas in the short horizons, it still provided a hedge. So that's just another kind of slightly complementary way of looking at it. And then, that I wanted to put on the table. And maybe my main comment for the authors, which I'm just going to state verbally here and then going to write it out. My main comment to the authors is I think it would be nice to have more expand on the discussion of the various channels at play here. I asked the question during the seminar just directly about flows. So I think it would be nice to go through different channels and discuss how the new intraday data could potentially help us discriminate between them. So just let me give you 3 quick examples. I know I only have a few minutes. One channel on top of what was discussed, I think, is inflation expectations, where we know from a long line of work that poor inflation dynamics, inflation process that's where inflation is higher with bad macroeconomic realizations, typically sees positive stock bond covariance, sees treasuries as risky. So to the extent this tariffs for inflationary, that could explain some of the convenience yield drop. And but of course, turns out in April 25, as I show in the middle here of this panel, measured via expected inflation, measured via break-even inflations, there was a surprisingly small increase in inflation expectations, perhaps puzzlingly low. Though in the Iran conflict, it's been a bit higher. So that's one channel, but maybe not that operative. Another channel that I think is very much in line with what Fulin said, but we have some data on it, is international flows. So what we do with VRL is we look at flows into long-term treasuries from the Treasury International Capital data, TIC data. And what we see is in April 2025 stands out that it had an aggregate outflow of 47 billion from long-term treasuries, whereas the last 3 years where we had the best quality data, typically there's a 47 billion inflow in that month. Okay, so just 100 billion gap, just for that month, but to us it represents a different dynamic. Typically in highly volatile months, there's inflows. This April 25, there were outflows, and we document that and we kind of account for the fact that typically most of these countries fly into U.S. treasuries in bad volatile times, but not this time. So I think that's one kind of direct channel. And I think these data, for instance, Canada was a country that sold $60 billion worth of treasuries in April 25. Fulin has data on country-specific tariff rates. Maybe there is a way to connect those two data points for a more specific point on the transmission. And the last thing I wanted to say is another channel that's operative is perhaps a search for a new target for safe asset flows. So when we look in the paper with Vera, we look at gold prices and dollar prices. And with gold, we find the following interesting fact that in days where in intraday data, stocks and bonds moved in the same direction, meaning bonds were seen as a risky asset, those are precisely the days when gold, in fact, behaved as a hedge to stock returns. So it seems there's some evidence that gold was behaving as a hedge or an alternative flight to safety asset. And similarly, as I mentioned earlier, short-term treasuries seem to have, at least in our measurement, been a recipient of some of those flight to safety flows. So I think those 3 extra data points would be nice to discuss more when we discuss the channels in question. But overall, thanks so much for having me and for the chance to participate.
Thank you so much, Tom. Should I respond briefly?
Yes.
Oh, yes, please.
Yes, I think Tom made several great points. The first one I think is the mostly two major points. One is the channels, and you specifically mentioned these inflation channels. I think we have some results that's consistent with like a positive stock one-coup movement when there is a heightened rising inflation expectations. So we basically did an exercise of like, for example, the inflation expectations impulse response to trade policy surprise. We see an increase in short-term inflation expectation and a decrease in longer-term inflation expectation. So at least for the shorter-term inflation expectation, that's kind of consistent with what you see. A higher inflation expectation, the treasuries become a worse hedge for the risky assets like the stocks. And then I think, but what's left on the table is more about like a closer look of these channels. So far, we have only used the prices data, but if we could take into account these flows, I think that would enrich the picture much more. In terms of the flows, I think you mentioned flows into there's outflows from U.S. Treasury and some inflows, for example, to Canada, if I interpreted it correctly.
Or Canada was the one that sold the most.
Oh, sold the most. Okay.
They sold the most.
I saw another piece of study from Bank of Canada shows some evidence that there is inflows to Canadian government bonds, but not in that period, but later on, like in late 2025. So I think this is a great idea because we have these cross-country measures, country-level measures of trade policy surprise. If we could have some measures of the flows into different foreign countries, or like how foreign countries sell U.S. treasuries, that would help a lot to tease out the channels. And this is also connected to like the second bigger question, which is like where does the money go? And you mentioned that in your study, the gold could attract some of the money and also short-term treasuries. And for our story, there is even something weird, but people have brought up this point that like crypto prices have also been rising. Maybe the money doesn't even go to a risk-free asset, it goes to some risky assets, and this is totally something opposite to a flight to safety story. So I guess for the first thing we need to do is to bring in, like, for example, gold prices. These data are immediate. And second is, and also this point about the money going into the short-term treasuries. I think that's mostly depends on the convenience yield measurement. We'll need to do a careful job there. And also in terms of some other risky asset classes, I think after we examine the price, or at least the price responses, we could have a more complete picture. Thanks for the comments.